Okay, we are going to be another few seconds before we start the webinar. I guess we can start with my introduction. Welcome to our webinar, which is part of a series of webinars organized by the CEPR RPN together with the NU Lab at the European University Institute. The webinar today will be on financial dominance. In particular, will be based on a paper, In Debt Supply and Monetary Policy, a Theory of Financial Dominance by our speaker, Viral Acharya, and with co-authors, and will be discussed by Emil Verner. During the seminar, we'll have, of course, time for audience intervention and questions. I just want to call your attention to the fact this is a joint seminar of the European Economic Policy RPN and the RPN on research in financial architecture, European financial architecture. Financial dominance is a topic of discussion among central bankers and policymakers. It is often raised as an issue. It is not often organized in terms of a framework about thinking why financial dominance is important and what are the channels, what are the special feature of the financial system that may create a constraint, a burden on the macroeconomic policy, macroeconomic stabilization. So today we'll see a proposal, a structural model that at the same time a academic contribution, but also a policy framework, a policy contribution to help us structuring our thinking. So I stop here. Again, welcome everybody to this CEPR series of RPN webinar together with the Emil Lab at the EUI. Jan Peter, if you want to.
Yes, Giancarlo, thank you. And welcome also from my side. So the RPN, European Financial Architecture, mostly works and discusses issues that relate to the financial architecture itself, not so much the macro side. And today the macro side comes in, basically connecting these two sides of the picture of the big financial market. And I'm really looking forward to looking or understanding better the model that Viral, or maybe the more general, the theory he is presenting. What are constraints for monetary policymakers they have to understand, and potentially what are policy options that emerge from that new understanding or that deeper understanding of these constraints. So thank you for both speakers, Viral and Emil, for delving and guiding us into this topic. And I hand over to Laura, who is the moderator of this session.
So thank you so much, Viral, for having accepted the invitation, also Emil, to discuss the paper. So I think it's a highly relevant topic, and it would be nice to look at all policy relevant issues to the paper, also looking at the latest outcome that we see into the market. So Viral does not need an introduction, we know. So everybody knows Viral. So I leave Viral the floor. You're going to have 25 minutes, and then I'm going to leave for Emil 15, 20 minutes for the discussion. And I ask the one online to post their questions directly, okay, so that we can read them. And unless they are really necessary to understand the paper, we should prefer to have the last questions at the end after the Emil discussion. So I leave you the floor to Viral. Thank you.
Can you hear me now?
Yes.
Yes. Thank you so much, Giancarlo, Laura, and Jan Peter for inviting this new paper that Guillaume Plantin of Science ISPO and my co-author at Stern, Olivier Wang, have been working on. It's called Indebted Supply and Monetary Policy, a Theory of Financial Dominance. And the idea is that we're going to try and formalize a notion of financial dominance in which monetary policy trade-offs are affected by past and current corporate capital structure decisions. More traditionally, financial dominance is thought of as more in the context of bond holdings of the banking system or leverage in the non-bank parts of the financial system, and how, in order to protect their net worth, monetary policy might get compromised in staying accommodative, or if it has created leverage in these parts of the banking system and non-banking system, how might tightening play out? In contrast, our focus is entirely on corporate capital structure decisions. This is not to say that the traditional notion of financial dominance isn't interesting or important, but we think that this corporate transmission of monetary policy perhaps gets a little bit less attention. What we are going to do, though, which I think goes also a little bit beyond the traditional treatment of financial dominance, is to actually cast it all in a macro model in which inflation, current output, and future output are going to be important quantities. And if I could sort of give you sort of what I learned from this model, it's really about how to think about corporate leverage as a relevant macroeconomic state variable for thinking about inflation and output outcomes. We're going to have it's a new theory in our view. Of course, it has several thoughts that are being borrowed from here and there, earlier contributions of several seminal papers. But what we have that's unique, I think, is a dynamic interaction between monetary policy and corporate balance sheets. So in terms of main results, we're going to take seriously this idea that when monetary policy is eased, it seems to favor debt financing a lot. Okay, we're going to have a slightly reduced form way of modeling this in our approach. We have some micro foundations in the appendices. But what that's going to do, first and foremost, is that monetary policy easing is going to trigger market timing in terms of debt issuances and leveraging up of the corporate sector. And that's going to have this follow-on consequence that when monetary policy is tightened, it might make rollover problems binding for firms, causing their future supply to become indebted. When they are financially constrained, they will reduce the supply that they have. So it's a combination of market timing caused by monetary policy easing, and then a tightening down the line causing supply side financial constraints. And we're going to do this in a new Keynesian style model. Second, this indebted supply that arises exposed because of past leveraging of the corporate sector is going to worsen central banks' inflation output trade-off. Perhaps interestingly, it's going to change the shape of the Phillips curve. Outstanding debt of the corporate sector is going to become a relevant macroeconomic state variable. That's going to actually change the shape and create a kink in the Phillips curve, so to speak. And what it's going to imply economically for monetary policy is that maintaining price stability might require a higher interest rate and lower output. The reason is because if the corporate sector is leveraged and you try to tighten, there's going to be a supply response. There's going to be a withdrawal of supply that's going to create a pressure against easing of inflation. And that's going to mean that in order to keep inflation at the target level, you might have to sacrifice output more. So taming inflationary shocks, in contrast, is going to become very, very costly in these. As a result, taming inflationary shocks is going to become very, very costly in this model. And thirdly, we have a new intertemporal trade-off in the model, which is that stabilizing current output is going to require slower recovery. So why is that? Because if you try to ease too much today, you're going to lever up your corporate sector. That's going to lead to these style of weaker output or recessions down the line. And in anticipation of that, through the standard intertemporal demand equation, households will save more today and not spend as much. So essentially, monetary policy today, by having this market timing impact on corporate leverage, is going to weaken the transmission to the real economy. Okay, so empirically, what we'll demonstrate is that ex ante, whenever monetary policy is tightened, it seems that cost of debt rises relative to cost of equity and leverage falls. Conversely, when you ease, debt financing picks up, leverage rises. Ex post, when monetary policy is tightened, higher inflation seems to be observed in sectors with higher credit risk, and we'll verify that this is not because of seemingly a demand effect. If anything, the sales in higher credit risk sectors seem to go down. Okay, so let me jump into the model. Parts of the model are really completely standard. We'll have firms on a continuum from 0 to 1, and they produce these goods of variety, let's call it I. And essentially, the households will consume an aggregate of all this heterogeneous goods through some elasticity of substitution through this CES aggregator. We don't really need the heterogeneity of firms other than when we have price rigidities in order to get some action from monetary policy through nominal monetary policy. The intertemporal preferences of households will again be standard. We're going to make the log assumption to derive simple analytical expressions. It can be easily extended to more general elasticity of intertemporal substitution. But we're going to make the other sort of simplifying assumptions that are standard in macro, so that there is risk sharing between households that own firms versus those that are primarily in the consumption side of the economy. Okay, that's going to give us just one Euler equation driven by this intertemporal preference. And you can see straight from that intertemporal preference that the savings are going to be a function of where you expect consumption to be tomorrow, and that's going to drive some of the feedback effects on ex ante transmission of monetary policy. Okay, firms is where the most of the action is. There are overlapping generation of firms living for 3 dates. In order to get tractability in the model, we're going to assume that the investments are of a fixed size K. So think about it as just like a plant that you set up requiring a certain investment. And at date T, a new set of firms arrives and they have to make this investment. The key is going to be how this investment K is financed, and I'll come to the capital structure decision next. What's important is that at date T plus 1, there's going to be a reinvestment need gamma K. So think about it as some continuing investments that you have to make in order to keep your technology productive. The idea is to have a Holmstrom Tirol kind of shock, but we're going to actually keep it deterministic so that we get simple closed form expressions. We don't have to think about cash management in the firm, etc., etc. So it's really for simplification. An important assumption is going to be that this reinvestment need is like intermediate inputs. It's not going to affect the demand of the economy at that point. That's something that we can relax in an extension. So the important thing is that this firm I, in general, has an AK style technology. It takes the labor N, the capital K, and there is this alpha 1 minus alpha substitution between them. The important point, though, is that the firm might have to scale down at date T plus 1 in order to be able to meet this reinvestment need gamma K. Okay, so it might be able to meet only a fraction X of the claim, in which case the output reduces from the potential output to x to the power nu, where nu is between 0 and 1. So either if nu is 0, then there's no impact of not being able to meet your full shock, or there is no shock, in which case you get a frictionless model, but in general, this will lead to a financial constraint. The optimal thing is to have X equal to 1, but if you can't roll over your existing capital structure claims that are due at date T plus 1, then you might have to accept a lower scale, the standard financial constraint model. What's going to be the implication of that? This is going to increase the marginal cost that the firm faces, and then that might affect the price that they're going to charge as well. And then at date T plus 2, there's a terminal value K. Now, the key aspect of the model is the capital structure decision of the firm. Essentially, there are two kinds of securities that the firm can issue at date T to fund itself. It can issue debt, and this is going to be assumed to be pledged only by the physical capital that can be liquidated at date T plus 2. And debt can be issued at both T and T plus 1. There are no dilution issues of the legacy debt at T plus 1. So think of it as short-term debt or secured debt or something that has anti-dilution covenants. At date T, the required gross return is RT. Importantly, the operating cash flows that were generated, that was this X to the power nu AKN, etc., that is not available to back debt. In fact, you can make it available, but it will be optimally chosen to finance outside equity in a manner that I'll explain. Okay, so the equation that is shown here is a key constraint, which is how much of a refinancing can the firm meet for its reinvestment shock at date T plus 1. Okay, so we're going to assume that only debt market is open at date T plus 1. So that's kind of capturing this idea that on the fly issuances of other claims are costly. So the firm has some debt L, that's the leverage of the firm. So that's the proportion of K that's financed with debt. So it's L times K. It has an interest payment due on it RT. So gross of interest, the repayment is RT LK. The amount of pledgeability at date T plus 1 is K over RT plus 1. Okay, so it's only the gap between the pledgeability and the non-dilutable debt claim that is available to finance the reinvestment needs of the firm. So gamma XK is bounded by the gap between K over RT plus 1 and the legacy debt payments that have to be made. So as you can see here, a lower interest rate RT is going to, of course, help, but not necessarily, because that's going to affect the leverage as well. But more importantly, RT plus 1, which is the new interest rate at time T plus 1, that's going to reduce the pledgeability from the future capital liquidation, and that's going to create a financial constraint by reducing X below 1 in general. What's the other claims then? Outside equity can only be issued at T, but not on the fly at date T plus 1. And it has some required gross return RET. And how are RT and RET related is going to be very important for the market timing assumptions. Okay, but before I go there, the important point is that as a function of the outstanding debt F, which is R times L, so that's the debt repayments that have to be made, the potential output is some y bar when X is equal to 1, but the realized output will be in general lower than that. And the firm has an optimal scale, xt plus 1, that's basically driven by that pledgeability constraint. So that's really one of the important finance aspects of the model, which is that the financial constraint is a function of legacy debt and the new interest rate in the model. New interest rate reduces the X, higher legacy debt reduces the X. So in general, what you're going to get is that if the new legacy interest rate is low enough, and that threshold R bar depends upon the legacy debt F, as you can see over there, then firms will be unconstrained. So if F is small, this is more likely to happen. However, if RT plus 1 is greater than this threshold, firms are constrained. The reinvestment scale is less than 1 and is going to decrease in the new interest rate and the legacy leverage. Okay, now the second interesting finance aspect of the paper is this optimal capital structure decision. It's in the spirit of market timing decisions. It looks like a static trade-off model of capital structure, but one in which instead of tax benefits of debt, you have market timing benefits of debt. Okay, so on the left-hand side is the net profits from production. In general, they will be reduced as a result of leverage, because leverage produces distress and financial constraints. It produces rollover problems that force you to scale back. However, why do firms still go for leverage in this model as a trade-off? It's because in general, debt financing might be cheaper than equity financing, and that wedge is given by this gap RE over RTE over RT minus 1. That's the cost of equity divided by cost of debt minus 1. So in general, if debt is less expensive because maybe there's a convenience yield on debt, or because there are other privileges associated with debt securities which drive the implied zero rate that prices equities as being different than debt, as in the recent zero beta rate work of Sebastian Ditella et al., then you will get a trade-off here, because the firm now is no longer just a real firm. It also has a financial arbitrage function. What is that function? It's a market timing function. A part of the firm's value comes from the fact that they are able to time the issuance of debt relative to equity in order to save on the equity issuance cost and benefit from the convenience yield that's attached to the debt claims. As I said, we have some micro foundations for why the costs of equity may be higher. The simplest one we can think of is that it leads to some costly state verification problem, because operating cash flows, unlike physical capital, are harder to verify. Okay, so that leads to this property that low rates lead to market timing, and that leads to an optimal ex-ante leverage from this static trade-off model, so to speak. It's static only because firms have only sort of two dates, more or less. Okay, so the key result is that everything can be summarized into the optimal scale of the firm at date t plus 1. Everything about the ex-ante leverage is relevant only in terms of what is going to be the continuation scale of the firm. And that's going to be driven by this quantity x bar, which is the optimal scale, and then multiplied by this wedge between debt and equity costs. Okay, so if debt is cheaper than equity, then that's going to lead to a lower scale in this model. Okay, now in general, what we find in data is that RT over RE is actually increasing in RT. So the benefits of debt are going to actually increase at low interest rates. So stronger monetary policy pass through to cost of debt rather than to cost of equity. And that's going to lead to this result, but we don't even need that. Even a constant gap between the two will do, as we'll see. So a lower rate RT now will lead to a higher leverage, and that will lead to a lower continuation value x star t plus 1. Now, so the question is there any support for this kind of market timing? So in finance, it's, of course, a big body of literature. My colleague Jeff Wergler embarked on this path with Malcolm Baker on a very influential market timing literature. They appeal to sort of more behavioral biases in pricing of claims. However, the question is, what do CFOs and CEOs really think? And from the Graham and Harvey 2001 survey, it's sort of very clear that they think that issuing debt when interest rates are particularly low is a part of what executives try to do. They try to time market in that sense in one of their empirical tables as well. And while not so important in the way we have modeled debt, there's also evidence that firms issue short-term debt in an effort to time market interest rates, because in practice, that might be a way of avoiding this dilution and getting rollover problems that I was describing. Okay, let me not show you the time series of our estimates of cost of equity, cost of debt, and Fed funds rate, but mostly jump into this simple relationship that if you look at the gap between cost of equity and cost of debt and relate it to the effective Fed funds rate, we can also do it with respect to monetary policy surprises, which is a better way to do it. But I just wanted to show you the raw data that there's a very strong negative relationship. Even constant would do for us, but actually the relationship is stronger, which is that at low rates, the relative advantage of debt is much higher. Okay, so now the question is how to cast all this into a model of optimal policy. To do that, we need interest rate policy to matter and not just be about the natural rates. So we introduce nominal rigidities in the standard way. Firms set a price P upper bar. However, only a fraction lambda of firms are able to reset their prices to P star at date T+1, depending upon the shocks that get realized at that point. And we assume that these shocks will be temporary so that everything then just reverts back to normal thereafter. The central bank can affect the date zero real rate R0 because of this price rigidities out there. Okay, so we'll focus on date zero, unanticipated demand, supply, financial, monetary policy, etc. type of shocks. But thereafter, there is perfect foresight because there are no shocks thereafter. Okay, so first important result on optimal policy is that monetary policy transmission is weak in a setup in which monetary policy can affect leverage of corporates, and that then affects the future distress of corporates. Okay, so a standard variable is how does the output react to changes in monetary policy rate. And what we get here is that at date zero, if the monetary policy is too accommodative, there is a dampening of the transmission of monetary policy. Okay, monetary policy is less effective at low rates. And the reason and the way this happens is a very sort of interesting linkage forward backwards, which is that monetary policy is going to create market timing incentives to issue debt. Higher debt through distress tomorrow is going to create a financial constraint that's going to hurt future supply through market timing today. But as a result of this, households will anticipate that consumption is going to be lower tomorrow. Think of it as a corporate leverage-induced recession that gets anticipated if monetary policy is too much, and then they will not consume as much today because they'll want to save into this recession state out there. It's a bit different than the banking or the zero lower bound literature, and we get it in a relatively straightforward manner in the model. So just to explain here, if you look at the output Y0 and you look at the interest rate R0 on the x-axis, in a frictionless model, the output is always going to be at Y upper bar, and then you have the demand function crossing it at some level R star. Now, what's a property of this leverage channel? The property of the leverage channel is that the impact of R0 there is an impact on current supply Y0. Okay, and so if you raise interest rates above this R star, supply is going to become constrained as a result of the leveraging. Now, of course, this can happen at a future date, and then that's going to have a backward impact on date zero outcomes. And so that's the more interesting part that I just showed, which is that now what's going to happen is that the impact of R0 is going to be on future supply Y1 and therefore on current demand. And so if monetary policy is accommodative below a level R lower bar, then actually the demand is flattened. The monetary policy today is not as effective because of the leverage consequences on aggregate supply in future. So now we can start thinking about what this means for dealing with shocks. You can think about the gap between this blue line and the red line, the demand and the supply lines, as basically the amount of inflation that has to be sustained for that particular point on the x-axis. And if you wanted to bring inflation down to zero, you have to basically make the two lines meet, and that's going to be the interest rate that helps you deliver on zero inflation. So it's a simple way of visually thinking about excess demand in this setup. So suppose you have a fiscal shock that shifts the monetary policy, that shifts the demand up from the dashed line to the thick line. Then what would happen in the standard model is that because there's no supply channel, you are all along the horizontal red line with dashed, and so you just move from to another point R star. Okay, but now you can see that with the supply having this distress effect because of the leveraging decisions, there's going to be a gap at the R star nu equal to 0 point. And that means you are sustaining some inflation at that point. So if you want to actually deliver zero inflation, you have to counteract the effect of indebted supply, and that's going to mean that you need an R star that exceeds the R star without the supply side channel. In other words, you actually need to tighten more in order to bring inflation down. Maybe this is one way of why in periods of high corporate leverage, you might have to bring interest rates to a level where you might have to actually trigger bankruptcies in order to bring inflation down, and otherwise the last mile catch up may be very, very hard. Now, similarly, negative demand shocks will require lower R star. So if now the demand shock goes from the dashed line down to the thick black line, then what is the problem? Now the problem is that monetary policy is not as effective in stimulating demand because of anticipation of corporate leverage induced recessions. And so instead of R star nu equal to 0, you have to accommodate to kill inflation up to R star. Okay, but the question is, do you really want to do this? And in general, in our model, that might not be the case. I want to point out that because kappa, which is the gap between the cost of debt and cost of equity, is exogenous, it's not clear where that goes. We can't do a very careful welfare analysis of all this, but something like this can happen, which is very interesting, which is that if you're thinking about boosting output up at date 0, one option is to do limited easing. Limited easing doesn't raise leverage as much. And so at date 1, it allows the economy to get back to normal because from that date onwards, there are no other shocks. However, if you ease a lot, then you create a part dependence in the economy by making corporate leverage too high, and that becomes a relevant state variable of the economy at date 1. Because now at date 1, the interest rates will actually produce a distress effect, a slowdown effect, and you take longer to recover rather than actually dealing with the temporary shock with a small correction. So this is the sense in which aggressive easing makes the path to steady state back slower in this model. Let me just make one final point, which is that we haven't fully worked all of these out, but we can, and we are working a bit more before releasing the paper on this, which is that a lot of the interesting aspects then come about what are financial shocks or policies that cause gaps between the cost of debt and equity as a function of monetary policy. So in general, a higher gap will make future supply more indebted. And as we said, that's going to act as a negative demand shock. So one way of thinking about a stock market crash, which increases cost of equity a lot, a flight to safety effect, or even the forward guidance of quantitative easing like a Fed put, all of that can be thought of as basically increasing these incentives to do market timing, giving corporate sector incentives to lever up when monetary policy is eased. And all of this will mean that future corporate recessions will be more likely, making the last mile of bringing inflation down costly in future. But importantly, they will also require you to ease a lot more because monetary policy is not as effective at date 0. So we think this possibility of thinking about interaction between conventional monetary policy and quantitative easing or unconventional monetary policy, one affecting R0, R1, and the other if affecting this gap between debt and equity, could be a simple way of thinking about interactions of conventional and unconventional monetary policy. Okay, I did mention at the beginning that we get this interesting result on the Phillips curve. So the Phillips curve in the model can be thought of as relating inflation to the output Y0. Y bar is the potential output. And what you get here in a very simple way as a result of this indebted supply effect is that essentially the F-1, which is the legacy corporate leverage, is going to become a relevant state variable for the Phillips curve, which is that when the output is below Y bar, actually inflation in this model is going to be higher because the lower output is coincident with corporates having become financially distressed through their leverage decisions of the past. What's interesting is that the shape of the Phillips
Viral,
is
Viral, I'm sorry to interrupt, but we
I'm
have
out of
to
time, right?
come to an end. Otherwise, there's
Yeah,
no
yeah.
room for discussion.
I'm at the end. Yes, yes. Okay. I think you get the picture that this curve is going to be flatter on the right. Okay. We have some evidence in the data confirming this channel of indebted supply and inflation. So let me just conclude. Indebted supply constrains inflation management for the central bank, weakening its transmission today and making it harder to bring down inflation in future. And we think that this could be an interesting way of thinking about financial dominance through corporate leverage rather than leverage of the financial sector. Let me stop there. Thank you.
Laura, I cannot hear you.
Now I understand why I was saying 2 minutes and nobody was listening, because I was muted. So sorry for that. So I leave
All
to
your fault,
Emil.
Laura. I never meant to take extra time.
I know. But in any case, Emil, the floor it's on you. So please, and then we are going to accept questions afterwards. Thank you.
Okay, wonderful. Thank you very much, Laura. And thank you also, Giancarlo and Jan-Peter, for having me to discuss this very interesting paper. So let me just say at the outset, this is a very, very neat paper. It's a very interesting to read. In particular, the model, which I see as the main contribution of the paper, provides some really interesting insights that you can see with pencil and paper. And so it's really clear what the model is bringing in terms of intuition. And I think you can teach this paper to your advanced undergrads, or at least your PhD students. And I think you should. So let me do the following in the discussion. So first, rather than just give you kind of one slide summarizing the paper, let me actually spend a few slides walking a little bit through the model again, just so we understand kind of the key features that are different in this model relative to kind of the standard New Keynesian framework. Then I'll talk a bit about some empirical evidence that I think are supportive of some of the key mechanisms. Then in my role as discussant, I'll sort of maybe challenge the authors a little bit in thinking about the relative roles of demand versus supply effects of leverage, so sort of indebted demand versus indebted supply. And then lastly, I'll talk a bit about policy implications and also encourage the authors to think a bit more about some of the interesting policy implications that could come out of the model. So let me first just talk about the model again. Viral was very clear, but I think this was helpful for me in terms of understanding the key features of the model. So hopefully it's also helpful for you. So as Viral said, that the demand side of the model is completely standard. So the key innovative feature is on the supply side, and in particular on this overlapping generations of firms that live for 3 periods. And essentially what happens is firms are born in period 0. What they do is they invest. So they have assets K that they invest in that they're going to use for production in period 1. And they finance that investment, loosely speaking, with debt, which is going to have this leverage L, and equity, which is going to be 1 minus L times K. And the key feature is that debt is going to be cheaper than equity. So then in period 1, the firms are going to do production. But before doing production, they have to do an additional investment or reinvestment. This is, for example, investing in intermediate inputs, as Viral said. So the investment is going to be this gamma times X, which is going to determine the scale of the firm, or actually the productivity, the TFP of the firm. And the scale is going to be between 0 and 1. And kind of the key of the model is that this additional investment in period 1 has to be backed by the assets K. You can't back it by cash flows. You can't issue equity. It has to be backed by K. And then the key equation, which is equation that Viral also showed, is that the investment in period 1 is going to be subject to this financial friction. And the financial friction works as follows. Because both the initial debt that you issued and this new reinvestment both have to be backed by K, there's going to be a limit to how much new investment you can do, how much X you can do, and that's going to depend on what your leverage was from the past. So I was trying to think of an analogy. The best one I could come up with this morning was, the dean lets me take on some debt in order to buy a new data set to write my paper. But then my MATLAB code, my MATLAB license expires, and I need to do a reinvestment in period 1, but I don't have any more debt capacity, so I can't run the new simulations of my paper, and so I have to submit a paper that's not quite as good as the paper that I wanted to do because I have this legacy debt L. Okay, so there's kind of a key connection between L that you chose in period T and then the reinvestment in T+1. And the reinvestment X is going to determine your productivity when you produce. So you produce using a kind of standard Cobb-Douglas technology, and the amount of X that you do is going to determine whether you have full scale or not. And so that means that the natural rate of output is going to be scaled by this X term here relative to sort of the standard that you would have in a new Keynesian model. And so if you end up in a situation where you can't do the full additional investment, where X T+1 is less than 1, then you're essentially a firm that has lower productivity, higher marginal cost, and so the natural rate of output is going to be below kind of your standard term. So in period 2, you then liquidate the debt and liquidate the capital and repay the debt. So most of the interesting action is in period 0 and 1. So let me just visualize kind of this key equation one more time, which is this pledgeability constraint, which says that the amount of leverage that you chose when you were born, plus the amount of reinvestment, that's going to be limited by 1 over R T+1, because both of these types of activities have to be backed by your final assets K, and they all scale with K, so K is going to cancel. So what that means is that this X T+1, the scale of your firm, is going to be the lower envelope of these two equations. So either it's going to be 1 or it's going to be less than 1. And so you can see if you chose a lot of leverage in the past, then you're going to have lower continuation scale tomorrow and lower TFP tomorrow. So then, Viral also showed this equation here. The firms basically face this trade-off theory in choosing leverage at time t, where the firms are rational. They understand that there's this risk of having too much leverage in the future. So they don't want to choose too much leverage because then there's a higher likelihood that they'll be constrained in T+1, and therefore they'll be less productive. So this is sort of reduced financial flexibility or cost of financial distress channel. So FC Barcelona, which is a team I follow, they're playing this afternoon, so they're on my mind. They took too much debt in the 2015s. Then all of a sudden there was a bad shock, and they had to let Messi go, and so then the stadium was half empty, and they're operating with X less than 1, right? So you don't want to do that. But at the same time, debt is cheaper than equity, and times when debt is especially cheap, you do want to increase your leverage. So you do the market timing. So you might set L sufficiently high, such that your scale is going to be too low in the future if the benefits of the market timing are sufficiently low. And so here you already see kind of this dynamic trade-off for monetary policy, which is if you stimulate the economy today, you lower R, well, that's going to benefit the economy today, but it's also going to raise leverage, which is going to potentially lower productive capacity in the future. Now, once you then get to the future, then monetary policy also affects how much reinvestment and production firms can do today. So one aspect is a dynamic aspect of monetary policy. One is within the period, which is if you unexpectedly tighten monetary policy today, so if you raise RT +1, then this whole schedule is going to shift inwards. And so all of a sudden, if you chose a pretty high leverage ratio and you thought you could just have a high enough scale to produce, so have X T+1 at 1, well, then if monetary policy unexpectedly tightens, then you'll have to scale down. You won't be able to finance your full reinvestment to operate at full scale, and so you actually won't be at the kind of highest level of the natural rate of output. The natural rate of output will fall, and supply will be constrained. And then finally, what this nice feature that this model gives is once you put it into a framework where firms have sticky prices, then you get this nonlinear Phillips curve, which says that the Phillips curve, and because marginal cost is going to depend on X and productivity is going to depend on X, the Phillips curve is going to depend on X. And because this X term here is essentially nonlinear, right? Then you can have situations where X is going to be less than 1, and then all of a sudden your output inflation trade-off is going to change. And so in particular, for example, if you raise interest rates, like I showed you before, then you're going to have to actually have lower scale. You just can't finance as much reinvestment. And so your marginal cost is going to be higher. And so that means that firms that are adjusting their prices are going to set higher prices. And that basically blunts the disinflationary effect of increasing R0. So in other words, there's like this negative supply side channel that's working against the standard supply side channel. And it's asymmetric because it really only matters when your X is going to be less than 1, which happens when the interest rate is high. And then you get these very interesting results on financial dominance. So for example, if you have a large positive demand shock, people become more impatient, they want to consume. Well, in the standard Keynesian model, you have divine coincidence. You just raise the interest rate to exactly offset the rise in demand. But here with indebted supply, you raise the interest rate, that leads to a fall in productive capacity or higher inflation. And so basically you can see that kind of this past leverage is constraining current monetary policy. And there's going to be this trade-off between stabilizing inflation and stabilizing output, and divine coincidence will fail. At the same time, if there's a large negative demand shock, then in the standard New Keynesian model, you just want to lower interest rates to boost consumption. But here, actually, it's a bit more complicated. You lower the interest rate, that's going to boost consumption, and it's going to boost the natural rate of output potentially. But it's also going to lower the future natural rate of output because you're going to bring more leverage into the future. And then this is going to feed back to time 0 because people know that they're going to be poorer in the future. So they're going to raise consumption less today, or this is going to lower consumption. And so then you need to ease even more in order to stabilize output. But if you're easing even more, then you're having more leverage and lower future output. So there's kind of this very interesting intertemporal trade-off, right? So the key here is monetary policy affects current and future output through supply, through leverage of firms. So let me talk a little bit about some empirical evidence that I think that the model actually connects with. So one is, in the past few years, we've had some nice papers showing that low interest rates really are often associated with large increases in leverage ratios up to financial crises. So for example, there's this nice paper by Grimm, Jorda, Schulerich, and Taylor. They look at data from 17 countries back to 1870. And this figure here basically shows what the stance of monetary policy, you can sort of think of this as just the monetary policy rate before crises. And what they show is that, before crises, monetary policy tends to be loose, leverage tends to go up, and then at some point, monetary policy wants to tighten, and often that may even be part of the trigger of the crisis. And so it's very clear you have these intertemporal effects and history dependence precisely through leverage. That's precisely what the model is getting at. Something else that I think is very true in the data is that what really matters is times when debt is especially cheap. So for example, in some of the work I've done, we looked at major credit booms in cross-country data. And you see that times when there's credit booms that you sort of identify by looking at periods when debt is growing very rapidly, these are times when credit spreads, so corporate credit spreads, are quite low. So it's not just monetary policy rates, it's also low credit spreads, consistent precisely with the idea in this paper that leverage growth is driven, especially when debt financing is especially cheap. And this is often driven by asymmetric pass-through of monetary policy into debt financing. Okay, because I'm a discussant though, let me kind of challenge a little bit the paper and have some debate on the role of demand versus supply. So, the key question I think is, does high corporate debt mainly constrain aggregate demand or aggregate supply? So to illustrate the point, and I applaud the authors for doing this, I think it's the right way to write the paper. They take a stark position and they put everything through supply, because then it's not muddied, it's not complicated, it's very clear. So for example, some assumptions that they are implicitly making is the K investment doesn't involve aggregate demand effects, and there's a fixed scale actually. So there's no kind of scale that's going to be affecting demand today. This reinvestment, this XT+1 reinvestment, is also assumed not to affect demand, though they do actually relax that, and that makes things more complicated. And then there's another assumption, which is on the timing. So they basically, when monetary policy affects your reinvestment, that affects the scale and supply immediately. So you have immediate supply effects, right? But if you, for example, had other modeling setups, then you could actually have situations where corporate debt distress could look more like deflationary demand shocks. So the basic idea I have in mind is that, often we think of in the short term as investment shocks being demand shocks. So for example, even if you're reducing productive capacity in the medium term, or there might be a lag. It might only happen in the medium term. And so if you have lower future productive capacity, that's going to lower current demand more than current supply. And so that could look more like a deflationary news shock, right? So, I mean, you could sort of write the model in different ways, and you could get it to operate in different ways. So
Emil, I
think
need to leave you 2 minutes because otherwise Viral won't have time to
Excellent.
answer.
Let me just quickly make these points, and then 2 minutes should be perfect. Thank you. I think it's very important to distinguish. I mean, if you think about indebted supply that has this clear trade-offs for monetary policy, it also suggests in this world where we have a lot of debt, things should be more inflationary and rates should be higher and supply should be more constrained, which is very different from the indebted demand view, which is that, in the world with a lot of debt, we're in a world with very low interest rates. And I think given where rates are and the debates about where things are going, that's a very important question to distinguish. The paper has some evidence on kind of this indebted supply channel. It's not really GE evidence, it's kind of sector specific. And there's also some other evidence from missing disinflation in the US Great Recession. The work I've done, and sort of I'm somewhat biased, is that often these financial distress shocks, in my view, look more like disinflationary demand shocks, even when they happen on the corporate side. So let me show you just one figure. For example, if you look at financial crises, which are sort of the most extreme type of episode of corporate and also household debt distress and distress in the banking system, you have that these are associated with big falls in GDP growth and also big falls in inflation. So these tend to be kind of disinflationary types of shocks. And financial crises also, another example this is from a paper by Ben-Gurion and Taylor, is typically countries that have financial crises, their exports don't change that much, but their imports fall a lot, which sort of suggests more a demand side than a productive capacity side. But of course, this is mixing many different things. It's not just the corporate leverage channel. There's also households. There's also banks. But I think that's kind of one of the key questions that this paper invites you to think about. And then lastly, I think there's scope for a follow-up paper to think a little bit more about implications for policy. I mean, if you're doing expansionary monetary policy to stimulate the economy, then you have this concern about indebted supply in the future. So then what do you want to do at the same time to try to reduce this? I mean, you want to reduce the wedge. You want to make it less attractive to take on debt. So, okay, should the central bank purchase equity instead of debt? Maybe that's a bit of an extreme idea. Maybe what you want to do is combine monetary policy with macroprudential policy. So maybe this is another case where actually you want to think about if you're easing a lot, and that's going to lead to a lot of leverage, maybe that's also a time where you want to think about leverage constraints or moral suasion to try to lower this L. And at the same time, if you're doing contractionary policy and you're having this negative kind of effect on supply, then you really want to try to support corporate borrowing and supply a lot while reducing demand. So then maybe you want to couple with relaxing macroprudential policy. And then, you want to do all kinds of other policies that can support supply, whether it's, fiscal policy or structural supply side reforms. Those might be especially beneficial during these times when supply is especially constrained. So, let me just wrap up here. The paper is addressing a really important issue because I really think we do live in an age of financial dominance with so much debt. The paper is very, very insightful. I'd encourage you to read it. And I think it's important to think about the role of this demand versus supply side effects going forward to sort of have a unified view of how financial dominance is going to affect interest rates, inflation, and monetary policy going forward. So thanks a lot, and I'll stop here.
Very good.
We don't hear you, Laura.
We need to.
Emil, thanks a lot. So thanks for the insightful discussion. Apart from the idea of citing Barcelona that is, playing today here in Milano. So, and we are on the other side. So for Barcelona, I am on the other side. So I don't know whether there are questions. I don't see any question here. Okay. I don't know whether Giancarlo has a question, then I might add something myself. So go ahead,
You want
Giancarlo.
to start, Laura?
No, go ahead. Go ahead.
I just like a comment. I enjoy both presentation, the discussion.
Yeah.
Even the inside baseball discussion of the MATLAB, I think it was very convincing. But yes, yeah. I just wonder. Remember, Viral, there was this long-term discussion. Tobin was very vocal on this. That interest rates are a cost. So when you raise interest rate, you have inflationary effect because the firms have higher cost. And the counter argument was that, of course, there's higher cost, but you also have lower demand. So at the end, it is inflationary. You sort of provide a new perspective on this debate, saying that it's not the cost that creates inflation, but the fact that directly you go into the basically equilibrium supply. You can refinance the size of the production, so you sort of scale down the potential output. So I found this very interesting in the sense that it's a kind of new vest of a classic debate, no, on demand versus supply effect, which may have lots of empirical leeway there, right? It would be interesting to see how much is really the cost of finance, but the inability to finance basically the activity of the firm. So a constraint that becomes more on the really a binding constraint on the activity. So I wonder whether you have a reaction to it's more of a comment than a question, but really it brought me back this classic debate.
So Viral, only a small question was related to what Emil saw on the line Emil was citing. So the idea of therefore which kind of fiscal policy you might well think, okay, on the demand side, or also by making debt more costly. I don't know whether you want to tax debt or something like that. So which is the optimal in some way policy you might well think about, okay, in order to smooth that adjustment.
So yeah, if I can also add one question, a little remark at least. So I mean, in corporate finance at least, there has been a long debate whether debt is really cheaper than equity. So you are probably pointing at specific unexpected events that produce this situation. The one situation I'm familiar with is from the banking literature, when you basically have an implicit government guarantee and then you get this gap more almost structurally and have this over indebtedness and all that. How this carries over to the corporate sector is remains a bit ad hoc to me in the way you discussed it, but maybe there's more to be said on this, and you can add a bit. Thank you.
Yeah, no, thank you for all these great questions. Thank you, Emil, for such a clear laying out of the model. Yeah, we should certainly touch upon some of the literature you mentioned by Grimm, Yorda, Schulerich, Taylor, and Jimenez et al., as well as your own work. Yeah, I fully agree that the indebted demand is at work in the data. I think as authors, we have no doubt of that. I think maybe perhaps one way of seeing what we are trying to do is to, for now, just lay out a framework in which the supply side of these effects can be understood as to how these are going to work. If at all we have some success with this body of work, our ambitious plan down the line is to actually have a framework in which we can have both of the effects working together. And that might allow us to think hard about in what kind of shocks and what kind of macroeconomic environments might you see the supply effects playing out more. I found the most recent episode in the US particularly interesting, where sort of demand was not as indebted, and in fact was basically stimulated through fiscal policy to high level. But then, the fiscal policy effectively caused interest rates to be raised. But it looked like, even though it depends a little bit on which side of the decision-making side you were, while the central bank thought they brought down inflation very quickly, many others grumbled that they could not quite bring it down to the target level. And in fact, they were struggling in spite of such a sharp and fast pace of rate hikes to bring it down. And I think what's interesting is that this happened in spite of the fact that mortgage rates pass-through was actually much stronger than the interest rate rise actually in the United States. So it seemed like not being able to bring down inflation might have had something to do with some other channels. So that's one point, which is I think there's a good case to embed the two together. The second thing I would say is that though our empirical work seems to suggest that at least in the cross-section of industrial sectors, if you look at the sort of inflation at sectoral levels, it looks like distress is interacting with the monetary policy shocks in a manner that generates this. And so while it could be that maybe the indebted demand channel is moving the overall level of inflation around, it could be that the supply effects still have some power in explaining why in some sectors inflation is higher than in others. Yeah, we definitely have in mind for sure to do a policy version of the paper. And I think the macroprudential and fiscal policy that you and Laura touched upon are probably the most interesting to investigate. We didn't think about buying equity. Actually, that's an interesting path to go. But I think we have to take a strong stand while doing that on what these wedges between the cost of debt and equity. Where does it go? Is it a dissipative cost or is it some kind of redistribution, etc.? And that's going to start playing an important role. But that's one thing we want to do. I fully agree with Giancarlo's point that in some ways what we are saying is that debt is a higher cost, but we don't think it should affect the inflation output trade-off unless it's operating through some real inefficiency. And we are formalizing that financial constraints might be a simple way to get at that. And I think on the last point that Jan Peter made, I again couldn't show the cross-sectional evidence on this, but what we do find is that this market timing channel of monetary policy shocks seems to be at work for large firms. It seems to be at work not just for bank-dominated, bank-dependent borrowers. It seems to work for firms which are, which have short-term debt, as I mentioned. And as you said, so if you take, for example, the work of Krishnamurthy Vissing Jorgensen, it seems that there are spillovers of convenience yield of safe assets even to some corporate securities like investment grade debt. It's very clear that in times of QE, we managed to transfer a kappa, this convenience yield to investment grade bonds as well, because pension funds, insurance companies, etc., seeking to have safe long-term assets started seeking investment grade bonds in their capital structure. And there are some very interesting statistics in the US leveraging. A lot of it is right at the cusp of the BBB. That's where more than 80% of debt issuances of bonds occur in the US now. The BBB rated bonds are like the fastest growing asset class since the global financial crisis and embarking upon QE. And at the time of COVID, a number of these things did get downgraded. But of course, COVID is such a complicated shock that it's hard to use it to tease out anything, partly because then the policy responses are very strong as well. But I think I broadly agree with your point that that the debt being cheaper, maybe the most, I would say, the easiest explanation is that there is some put somewhere.
Can I just wonder? So when companies in such situation raise their debt suddenly, could it be that because of low interest rates, the value of collateral is also rising? I mean, it's not, in their subjective way, they may not feel that they increase leverage.
Yes.
So I mean, it works in both directions. So it's also the collateral is, although in most representations, since you use balance sheets which rely on book values mostly, if
Yeah.
Real
So
assets are concerned.
indeed,
You don't
so I
see
think
that.
like we don't put it that way, but that is exactly how the leveraging is happening in the model,
Okay.
because you compare your debt repayments to the future value of capital.
Right.
Instead, if you brought everything down today, it would look like at low interest rates relative to the debt you took on, your debt capacity has actually expanded. Absolutely. Yes, yes, yes. And just one last point, which is that, since I'm from an emerging market originally, I almost never thought of demand shocks. For me, my entire life was about supply shocks. And in fact, I pushed very hard with my co-authors, but then we resisted in the end to do it, which is that I, in fact, think this could even be the way that sometimes government policy gets constrained, which is that governments have to make some useful infrastructure investments.
Yes.
And if you stimulate interest rates to be very low, they might lever up. And then when rates rise in future, the governments may become constrained because they also have some pleasurable cash flows and their values decline. And then they might have to cut back on infrastructure investments. And now that becomes like a supply side shock into inflation in the economy. So anyway, so I think for us, sometimes we even get asked the question like, what's the point of writing down this model if you're not doing any calibration, etc. And I think I go a little bit the way Emil described, that it's like a textbook way of doing things to just form some strong intuitions. And the hope is that it's a framework that we can build upon to do more things down the line. So.
I think it is well done.
Yeah.
In that direction. Thank you.
If I make a very last comment, well, I
Yes,
agree
yes.
that shocks are shocks. They have all demand and supply sides or effects. But what I want to say is it would be interesting to see how firms preset prices in the model, because I suspect that in this plain vanilla Newkensian's model, the presetting, the firms try to be as close as possible to the natural rate. In your case, it's impossible, which is you always have this extra movement of demand and supply that creates inflation. And there is a Jensen's inequality term there, which, I value the nominal profits at the inflation with the distribution of inflation. This Jensen inequality term is usually not relevant in most applications. When you have other distortions, becomes relevant. Why I'm raising this? Because it makes firms a little bit more prudent. So there is a sense in which even the natural rate of output becomes sort of away from potential output, because it's sort of an increase in the exercise of monopoly power. This is a result that is very clear in international, simply because we have more leeway. And I discovered during, with Berger and others that the interaction with other distortion may actually be large. So I wonder whether a part of the stress that comes from the supply goes also in ex ante, like sort of, you could talk about exacerbating the monopoly power of the firm, right? You lower output in expectation. I suspect, I need to work it out, but if that is true, we also have a little bit of a cost of insufficient stabilization that come out also ex ante, not only ex post, but also ex ante. So this is a conjecture, but I will check it out. I think it's one of these nice exercises.
Yes. I have to think through that channel a little bit more. I think one thing that I find, so I think there are 2 or 3 equations that are key to the model, but I like this static trade-off model of the capital structure quite a lot. I increasingly think that, so for example, markets just know, for example, that Fed is right now not allowed to purchase equity, that there would have to be like a relaxation of the rules. They can right now only do, that means they could in principle do repo financing. I don't know. But at least markets know this. And then this says that these kinds of distortions and their exercise is will automatically create the financial arm of the corporate capital structure decision makers to immediately sort of start acting on exploiting these. Of course, there are newer papers coming out which are showing that the Fed announcements are shaping the expectations that
Exactly.
investors attach to the distribution. So Haddad, Moreira, and Muir are doing some interesting work, both with the Fed stabilization in COVID and then the general QE stabilization, that it actually shapes the distribution of outcomes that the investors are attaching.
Of course.
And the COVID paper is particularly interesting because they show that the implied distributions are different between equity and debt markets. So debt market implied tail risk is lower than the equity market implied tail risk. And so, but I fully agree that thinking about the perceptions of investors and the distributions that they attach could be a way to actually get at this kappa in some interesting ways.
And to close with the European economic policy, especially Draghi report investment. So this is there is the link between macro stabilization and the basically risk taking in a real term, so an investment.
Yes.
I think that ensuring against the very long tail, negative tail that we had in the past in Europe would actually be a precondition for really doing anything in Europe.
Yes.
So
Yes.
system of policy making that avoids not run the economy hot, but avoid the cold winter of large shock that are really destroying productive capacity. In a way, it is very much in your spirit of the supply side.
Yes.
Distress that ex ante may have also a constraint effect. I think I'm sorry.
We are running out of time. Yes, but it was interesting. Exactly. It was super interesting. So we were not looking at the time. So let me thanks all of you. So Viral and of course your co-author that didn't show up, but we were thinking about them. And Emil, thank you so much.